What is up, guys? Taiki here, and in this video I'll be going over how I'll be approaching the markets, with the humble farmer mindset, delta neutral and hedged volatility farming strategy. So if you like the content, please like and subscribe and leave a comment in the comment section below. None of this is financial advice. So I mentioned this in my last video that I uploaded on Saturday, but I would expect the next couple of weeks, even maybe the next couple of months, to be slow. Right, and slow just means that we're not going to see like crazy pumps, crazy dumps. I mean, we might get crazy dumps to be honest. But the point I'm trying to make is, I think a lot of people enter crypto for the instant dopamine, right? Like majority of people enter crypto when things are going up. They buy something, it goes up, they just feel great. Then things go down, they're like, damn it, and then it pumps again. It's like, oh my god, I'm the best trader ever. But I think in this type of environment, the markets need some time to digest itself. Okay, there's lots of things happening with macro. There's a lot of volatility today with all like the FOMC stuff, and fundamentally, some of these crypto, I think, has a lot more downside to go, right? Because in a bull market, rising tide lifts all boats. Anything you buy can go up, but in a more, I guess, neutral to bearish environment, fundamentals start to matter. Okay, and you can start to argue that, hey, like maybe some of your coins that that were shilled to you, 2 months ago, maybe they don't have like that strong fundamentals, and if they don't have fundamentals, then they don't have a lasting power, then maybe the trend is going to zero, right? So just be more careful, is like my point when it comes to allocating into new assets, new coins, whatever. So let's kind of go over my strategy for Q1. So I entered Q1 at the beginning of the year with an optimistic outlook for L1s. I essentially said, like, I think Ethereum dominance in terms of TVL was going to go down, and that has happened, right? I think TVL growth on Phantom, chains like that has gone up, and ETH TVL has kind of, gone sideways. But price is down, right? So no one really cares when price is going down. So how do we position ourselves in this environment? So I mean, not financial advice, of course, but me personally, I'm not going to position like too aggressively in terms of, like buying new altcoins, like, oh, like, this thing has pump. Yeah, I'm not going to, look into those assets. My main goal is survival, because, if you expect the markets to, be up and to the right, then, in like harsher market conditions, maybe it's like best to play it safe, right? And maybe you just enter safer farms and then come back in a month or two, when maybe the market conditions are a lot easier, is what I mean. So for me, if I do DC, right, some of the assets I've already purchased, it's going to be in safer assets, and I'm going to start hedging strategies if we get a sizable bounce, which I'll go over later in the video. My main priority for the next couple of months or weeks, depending on like how the tape changes, is to minimize downside, or is to prioritize minimizing downside over maximizing upside. Okay, I'd rather I'm going to prioritize not losing too much money if we go down over making a lot of money if we go up, for example, right? Because there's going to be a lot easier. Yeah, like I said, if you expect the markets to go like this, then you don't really have to position too aggressively when there's when the sentiment across the board is pretty grim, right? So what do I mean by conservative buys? I'm going to focus my buys on collateralizable assets like ETH, right? And, maybe Bitcoin, and depending on the chain you're on, right? AVAX, FTM, etc. Or yield-bearing assets like GLP on GMX or HRAC crypto on Curve. I'll talk about some of these assets later on in the video. There will come a day where, easy longs and easy money will be made. Until then, main goal is survival. Okay, so like think back to, I guess, this summer, right? Let's say you're in the markets in June, right? And May, June, July was pretty sad, right? I mean, things were just like not looking good. We breached like below 30K in Bitcoin, but starting in around like later in July, August, September, like those were like the easy money situations. So I think we're in like the May, June, July scenario where there's not going to be too many bullish candles happening. I think maybe pockets in crypto sectors, certain sectors can do well, but from a more macro perspective, I don't really expect any like crazy pumping, like pumps, is what I mean. And maybe the strategy is to be safe, and then once the market tells you that it's back on, right? Maybe that's when you start to position more aggressively, right? You don't have to make 5% gains every single day. Maybe the safer bet is to be conservative and then position more aggressively when like things are more obviously bullish. So I talk about collateralizable assets, right? Bitcoin and Ether. I talk about this a lot on my channel, but I think, I think in these scenarios, in these conditions, these strategies have more merit. And I do want to go over some strategies that I have not yet covered on this channel that I think is interesting in terms of like, just hedging your portfolio. Because I understand that, some of my Bitcoin, like some of my ETH, they're in like short-term to long-term capital gains. And, I think a lot of people fall under that category. Maybe you don't want to sell your assets, right? So how can we hedge your positions without having to realize capital gains? So strategy one, which I'm not going to spend too much time on, that I've discussed like for many months on this channel, is use collateral assets, borrow dollars, farm with those dollars, right? And super simple. You don't really have to think about it. Just keep your health factor safe, and you should be fine, right? Farm Platypus on Avalanche, Curve on whatever chain, etc. Right? There's a bunch of stablecoin farms across the board. So strategy two, which I want to spend more time on, is this idea of lower volatility hedging. Okay, and this is a way to, let's say you have ETH and you want to hedge against the downside protection, right? How do you protect the downside? What you can do is this simple strategy of borrow ETH and long try crypto on Curve. Okay, so you're borrowing ETH and then you're buying try crypto. So you're short ETH because you borrow ETH and you sell it, but you're longing a more volatility muted asset, which is try crypto. Okay, so for example, I don't know when I took the screenshot some time ago, but let's say you have one Bitcoin on a money market and you borrow 3 ETH, right? And what do you do with the 3 ETH, right? And like this is where the strategy comes in. So this is the try crypto on Phantom. For those that don't know, it's essentially a liquidity provider pool where it's 33% stables, 33% Bitcoin, and 33% ETH. Okay, and you can earn roughly 23% right now on Phantom. Or at least I took the screenshot yesterday, so roughly 23%. So this is like the steps you can take, right? I'm not doing this right now. There's other strategies I'll talk about, but this is something that you could do. So you're long one Bitcoin, right? And you put it in a money market and you borrow 3 ETH, which when you long try crypto, you're short, right? Because when you short something, you borrow it, you sell it, hoping to buy back lower, earning 23, 24%. And what happens when you long try crypto is you split up your 3 ETH into 3 assets. 1 ETH into stables, 1 ETH into Bitcoin, and 1 ETH is it's still ETH, I guess. So let's kind of go over like the math of what happens if Bitcoin goes up, or if Bitcoin goes down, right? And the same goes for ETH. So this is what happens, right? Let's just assume that ETH is $2,500, Bitcoin is 40K, just to use round numbers. So when you short 3 ETH into try crypto, you take $7,500 worth of ETH and you split it into Bitcoin, ETH, and stablecoins, right? This is essentially what happens. So let's go over one of the scenarios where Bitcoin and ETH goes up, right? So you're hedging your position, you're short ETH, you're long try crypto. What happens when you do this strategy? So if these assets go up by this much, the result is that roughly your position is going to be like this, right? And because you owe 3 ETH, right, $9,000. Because of this hedging strategy, you're going to be down $750, right? Now, it's not going to be exactly $750. I'm just using like round numbers just so I can like show the math a lot easier, because it is a liquidity provider position. These positions are going to be rebalanced, right? So it's 38% Bitcoin, ETH, stablecoin. So there's going to be some impermanent loss, but I'm just trying to get across this overview, right? Just to simplify the numbers, right? So if Bitcoin and ETH goes up, right, you lose money because you're short ETH and you're longing try crypto. However, this could be, maybe you don't care, right? Because maybe you're risk on in other areas of the market and you want to be able to hedge in case the markets go down. So what happens if the markets do go down? So let's say Bitcoin goes down another 10%, ETH goes down minus 20%. And then the value of your LPs are going to be like this, right? Where, Bitcoin's down, ETH is down, stablecoin's down. Well, sure, your position went down, but you owe 3 ETH, right? Because you're borrowing 3 ETH. And now the value of the 3 ETH is $6,000, right? Because, 2,000 times 3. So because this position is roughly worth $6,750, you're going to be profiting $750. Of course, there's impermanent loss. I'm not taking into impermanent loss in this example. So your profit and loss is going to be, maybe less or higher, depending on how the markets actually move. But, the idea is to borrow an asset. You buy try crypto, which is a volatility muted position, and you live with the results, right? And depending on your motives, right? Even if it goes up, then that's fine, right? This is a cost you pay to hedge in case the markets go down, where you can profit on this position, right? Not to mention, you're earning 23% yield, right? So, whatever your time horizon is, maybe, you accumulate some curve, accumulate some phantom, accumulate, like whatever assets that they pay you, and you're totally fine, right? I think it's I think it's a neat trick to hedge your portfolio without selling your collateral, and you get to earn yield while you're at it, right? Hopefully that made sense. Yeah. Obviously, there's some impermanent loss, but you get the point I'm trying to make here. Okay, so how about some higher volatility hedging, right? Because shorting ETH to long track crypto, if the market really dumps, then maybe you want to hedge an altcoin, right? And maybe you want to. I mean, this is an example. It's just a higher volatility hedging. You borrow AVAX and you long AVAX MIM on Joe. Okay, so you borrow AVAX, you short. Essentially, you borrow AVAX, right? And then you convert your AVAX into AVAX MIM on Joe, which I took the screenshot yesterday, but it's paying roughly 100%, 23% in Joe and 83% in terms of like swap fees. And this applies to like Phantom too. Like you can borrow FTM on Geist and then split it into like Phantom USDC on SpookySwap or something, right? So don't focus on the asset itself, but just focus on the concept at hand. So you're essentially selling half your AVAX into a stablecoin, because let's say you borrow $10,000. I don't have numbers. Let's say you borrow $10,000 with the AVAX. You sell $5,000 into MIM, right? And you have $5,000 AVAX, $5,000 of MIM, and you provide liquidity, right? So if AVAX enters a correction, like you're going to profit, right? Because the amounts that you borrow is going to be worth less, right? And you sold half of your AVAX into MIM. There's going to be some impermanent loss, but with the farming rewards, you're going to be you'll be profiting. If AVAX goes up, then obviously you're going to owe more in debt, so you're going to lose whatever money you have in terms of, I guess, profit or loss. However, that's not the point, right? The point isn't to encourage everyone from shorting. The point is these are different strategies that you can use that isn't like, I guess, obvious, right? Because borrowing AVAX to sell into USDC, farming with stablecoins, sure, that's like just a regular direct shorting strategy. But if you want to have some volatility muted, while still like being completely, while still not wanting to be like 100% short, these are strategies you can deploy, right? This is applicable on Ethereum, Arbitrum, Phantom, like whatever, right? Because these yields on number one, the decentralized exchanges, they're pretty good, right? So I mean, even imagine a scenario where you do this strategy and the AVAX goes sideways, right? Well, then you earn like 106% in APR, and when you repay your debt, you're going to profit, right? So I think in these types of environments, I think it's good to consider these types of strategies. There are other ones, right? But just simply going over a few examples, get your head, get your brain thinking, right? I've also heard like strategies where like you have Bitcoin as collateral, you borrow Bitcoin in Ether, and then you deposit Bitcoin in Ether into DEX, and then you like dump your yield to pay off your loan or something, right? So there's different things you can do with money markets, and this is like why money markets are so important to these ecosystems, right? Because without money markets, it's really hard to lock in liquidity, and that's why like when Aave launched on AVAX, when Geist launched on Phantom, those were bullish catalysts for these random ecosystems, or not random, but these various ecosystems. So yeah, you can do this on any chains. So in summary, for the next couple of weeks, I'm gonna try to play great defense, right? Defense wins championships, and I don't care about maximizing my gains, but I do care more about survival, right? I care more about not losing too much on a dump, even if that means not making as much on the way up. Okay, and I think this is a good mindset to have, right? Where you prepare for the worst, but if the markets go up, you're still fine, right? Because I'm not saying you should like short everything with your net worth. I'm just saying like maybe you have like 100K in crypto, right? Maybe you open like a 30K hedge, right, against your collateral or something. That way, if the markets go down, you still lose money, but you're still hedged. If the markets go up, then you don't make as much money, but that's the cost you paid in order to hedge. And at least you're earning yield while you're at it. So if you like the content, please like and subscribe. Leave a comment in the comment section below. Hopefully this video was useful. And I'm trying to teach various strategies that isn't obvious as like, oh yeah, buy this coin, earn yield, stake it, ooh, hallelujah. Just there are different tricks you can use with money markets, which I think is very, very valuable when you're in DeFi. Thank you for watching. Have a good one. And yeah, have fun and be safe farming out there.